Okay, let's kick off. So, hi everyone, I'm Immad Akhund. I'm the founder and CEO of Mercury. Welcome to this event. We're really going to kind of focus on seed rounds and raising a seed round. Our guest is Leo Polovets. He's the co-founder and general partner at Susa Ventures. Susa is a seed fund. They've invested in Flexport, Robinhood, and many other great companies. Prior to Susa, Leo was the second engineer at LinkedIn. He built the first version of LinkedIn Jobs and LinkedIn Groups. Thanks for joining us, Leo.
Thanks. I'm really excited to be here.
I guess just one general question before we dive into seed rounds. How did you transition from an engineer into kind of a seed VC?
Yeah, I mean, I can talk a little bit about the why and the how. The why was I worked at LinkedIn and at another startup at the 15 to 50 person phase. And I like that a lot. Towards the end of my time as an engineer, I wanted to start my own company, but I felt like I didn't know anything about, what it took to start a company from day one. I'd always seen them from kind of like day 200. And so I wanted to learn more about that. And I had a few friends that were angel investors. They were starting to work together. They were thinking of starting an angel fund or a venture fund. And they wanted a technical person on the team. And so one of them invited me to try it out for a little bit. And I was like, oh, this is great. I'll do it for a year. I'll learn a lot about really early stage startups and kind of like the things they do well, the mistakes they make, and then I'll go start my own company. And instead I ended up really liking it. And so I've just been at Susa Ventures, ever since inception about 8 years ago. In terms of the how or like what the transition was like, it was definitely, it was very different than engineering. I think the biggest thing I learned was just being able to have good mentors and learn from other people was really useful. Because as a novice investor, I just got really excited about everything. I wasn't really sure what questions to ask. And I think, if you had talked to me in my first couple of months, I probably would have wanted to invest in half the companies I met. Whereas I think for most seed investors, that number probably ends up being closer to 1 or 2%. And so just being able to talk to other people, kind of calibrate opinions, see what kind of questions they ask. I think that was probably the most useful thing for getting started in investing.
How have things changed kind of in the last year with the pandemic and kind of virtual fundraising? How's that been from your perspective?
I think it's definitely been an interesting year. And I think a lot of this depends fund to fund. So for us, for example, we started out with the team being distributed 8 years ago. And so we got pretty used to doing phone calls, sometimes video calls, where either nobody on the team had met a founder in person or maybe one of the three partners had. And so we got pretty used to that. And so I think with, post COVID where everything's on Zoom, it's been a pretty easy transition for us. I think where I've seen other funds where they haven't had that experience, they sometimes struggle with that transition. And, I think people want to get comfortable with it when they're making an investment of, $1 million or sometimes for the Series A fund, maybe it's $10 million. And so when things transition to Zoom and people no longer feel quite as confident in their ability to kind of evaluate founding teams and ideas over video instead of in person, I think that sometimes leads to, some funds are just less active. Some funds are just as active, but the processes are longer. And I think it's just one of those things where everyone's kind of adjusting on the fly, and it's going to just really vary fund to fund. And you kind of have to see how each fund is operating when you talk to them.
Do you think it's made it so certain types of companies where there's some sort of stamp, it's a YC company or someone's coming out of, another unicorn startups, they've ended up doing better because there's certain level of kind of implicit trust in the stamp, or you haven't seen that change?
I would say, I think there's not a huge shift in that direction, but I think there is a shift in that direction, right? Which is when people feel like it's more risky to invest, over video instead of in person, then they kind of look for well, what are the things they think that, that might mitigate some risks? And I think the school you went to, YC, or, the startup you worked at or started, those become stronger signals. I'd also say, I think demos become more powerful too. If you have a really good demo, that can really help you stand out, because I think over video, not a lot of things stand out as much. And so if you can show a product where even in a few minutes, the audience is going wow, this is amazing. I think that can be a really powerful thing.
Oh, really? I find that a lot of founders don't lead with demos. Do you think that's a good thing to always include, have a demo of your product in the pitch?
I mean, I think it depends on the demo, right? Like, I think because sometimes the product's amazing, and sometimes honestly it doesn't need to be amazing, right? Because maybe you're trying to make a customer more efficient by like digitizing some process, and you're just replacing like paper forms with web forms. Like, it's probably not going to be really sleek and amazing. And so there, maybe the product is less important than like your understanding of the customer and what they want. But there's other cases where, like for example, there's a stealth company I work with that does website personalization, and sort of in a few clicks they could start like really personalizing any website's content to you, whether it's like e-commerce or a publisher. And so they have this really awesome demo where like they log into a site fresh, they do a few clicks on different links, and they show you like here's what you get this personalized content. And then you could basically like log in, do a few different clicks, and say like, hey, look, your homepage looks totally different now. And like the personalization is like really stark and effective. And so just that like 2-minute demo, I think gets everyone they've talked to really excited about it.
When it comes to kind of, I guess, meeting entrepreneurs, do you mostly rely on kind of network and introductions, or do you also take kind of cold intros or cold emails?
Yeah, it's a mix. I think introductions and network are definitely a big piece for basically every investor I know, even the ones that take cold emails and messages and DMs. Um, I've definitely, on our side, we've definitely been receptive to like cold emails. I think our networks, maybe they cover, like, if we're lucky, our second degree might cover like 1% of the United States or something, or probably even less. And that's a lot of other people that are really talented and hardworking and smart that we can't reach through like our second degree connections. So we definitely want to be open-minded to that.
When you see like an initial email, either from an introduction or it's a cold message, like what are the few things that you look for that like you're like, okay, this startup stands out to you?
It's a really good question. I think it actually comes up a lot because over the years, this has been interesting to see, but like our cold email volumes ramped up quite a bit. So like when we first started, I think we basically got like no inbound pitches because like nobody heard who we were, like nobody knew who we were, nobody cared who we were. And then maybe a couple of years in, we were getting like a few emails a week or something like that. I think at this point, I probably get something like 30 or 50 a week, which is like a pretty high volume. And, I think I don't have, like, even if I had no meetings from my network or from introductions, I don't think I have time to actually look at like 50 companies a week, in depth. Um, and so, your question about like, what does it take to stand out? I think the standing out is actually the really important thing, because there are a lot of emails that are very like, they're kind of more bland and generic, right? Where people are like, oh, here's my company, here's what we do. And like, do you want to talk to us? And I think you have to really put like one or two bullet points in there of like, hey, here's like something really special or something really exciting about us. And this is why, like, when you get 50 emails, but maybe you have time to like really spend more time with 3, like, here's why we should be one of the 3. And so I think featuring highlights is important. I think some personalization is important too, right? Because I get a lot of emails that are either not personalized at all, right? Where it's like, dear sir or madam, I'm fundraising, like, do you want to check out our deck? Or there's things that are sort of, they're personalized, but in a very superficial way. Where like, I'll get emails, for example, where somebody say like, hey, like I saw, I read about Susa Ventures. I saw you guys invested in this company. We think you'd like us. And a lot of times, like, the other company is actually like unrelated, right? So somebody will be like, oh, you invested in this fintech company. We make a product for lawyers. And it's like, okay, like I'm not really sure what the connection is. And it's like, I could tell the person tried to personalize it, but they probably spent like 5 seconds on it. But then once in a while, you get an email where somebody's like, oh, like I read this tweet where you said you like this kind of product. That's exactly what we're building. Let's chat. And that's actually like, that works a lot better if you have that level of like just a little bit of personalization. Um,
Uh,
yeah.
I mean, I guess like something standing out is like inherent to the company, but are there certain types of things that stand out to you? Like, is it like, we're doing like 50K in revenue per month or something like that? Is that the kind of thing that stands out to you, or it's like more like market driven? Like, what are the things that you think stand out?
So I don't know if this is super helpful to the audience, but I would say it's more about like relative to other companies, right? So, like for example, 50K a month, it's very context based, right? So if you raise like $4 million, maybe hitting 50K a month is not that impressive. Like if you bootstrap to 50K a month, like 3 months after launch, that's super impressive. And so I think a lot of it is kind of like thinking about what I see across a lot of pitches or a lot of companies, and then looking for things that stand out. And it could be the team quality, it could be the traction, which, could be the absolute traction of like, what's the revenue you hit? It could be the growth, which is like maybe your revenue is low, but you're growing really quickly. It could be like maybe like some like you're in an industry that's really exciting and you have especially good experience there. So there's a lot of angles it could be, but I think the goal is like, is there some area where it feels like this company's maybe in the top, 1 or 2 or 3% of the companies we look at?
Is there one thing that is most important to you, like market or team or product attraction? Is one of them like your guiding star or anything like that?
I think it probably varies for each person on my team. So coming from an engineering background, I probably spend more time on the product and kind of how it fits into the market. I think my partners tend to be more team oriented and market size oriented. And so I think, probably all of us make good and bad decisions, but combined, hopefully it's a little bit better because we have different perspectives.
Let's say someone gets that kind of first meeting with you. What are what are like good ways of spending the first, I don't know, like the first 15 minutes, and what are bad ways of spending the first 15 minutes in a pitch?
Um, so I would say like, most pitches, like they start with a few minutes of intros, and then usually the founder spends some time talking about what they built so far, like their vision, where they're going. I think probably the biggest issue I see is like when that pitch is not succinct. And so if you have like a 45-minute meeting and you spend like 42 minutes going through your deck and telling your story, it ends up being like actually really hard as an investor to figure out what to do from there, because I might have a lot of questions and there was no time to ask any of them. And so now, like, just based on kind of watching the effectively like a pre-recorded pitch live, I have to decide whether to spend maybe like another hour together. And my tendency is like I always want to spend more time with people, like learn more about what they're doing, but unfortunately, like I only have so much time in the schedule. And so I think what you want to do is like whatever length your pitch meeting is, whether it's 30 minutes, 45 minutes, an hour, you want to spend maybe like a third of the time doing an overview. And obviously it's not a hard rule, but maybe spend 10, 15, 20 minutes out of an hour meeting talking about, here's our background, like here's what we've built, here's why it's exciting. But then you want to leave a lot of time for questions and make it interactive.
Mhm.
I think both because the investor wants to learn like whatever things they're interested in or like wondering about, and two is you could also see like are they the right investor for you? Are they asking good questions? Are there things where maybe like they're asking good questions and you don't have great answers, and so maybe you need to spend like some time researching or preparing answers there. So I think being succinct is important, which is maybe ironic because I'm rambling a little bit. And then I think the other thing is also just like not like being pretty honest and not overselling or underselling things too much, right? Because I think investors basically want to see like, would you be good to work with? Like, are you trustworthy? And so that's the like not overselling part. But then the other side is like, you're going to be, as a founder, you're going to be selling to investors, but to customers, employees, like you're pitching your company to a lot of people. And so I think, investors want to see that you're like pretty confident you can make it, sound kind of exciting, right? Where it's not sort of like an academic, kind of dry delivery.
Yeah, I do think there's that balance is difficult, like not
Absolutely.
overselling and not underselling. Is there a trick or something, or like a way to prepare that like you can get that balance right?
Well, I would say like the not overselling thing is like don't lie or don't exaggerate. Um, and I think the not underselling thing is like I'd probably go up to the line of that, like where you're kind of as excited, like you show like as much excitement as you have, and you like kind of talk up your ideas and your what you've done as much as you can, uh, but up to the point where like you don't get into the area where you're exaggerating or outright dishonest.
Yeah, I think energy level makes a big difference there as well. Like I
Yeah.
think some people are just by themselves like very energetic, and other people are a little like not. So that helps. And okay, and so I guess let's say the pitch meeting's done. Like, actually, one question about the pitch meeting: do you like decks, or are you prefer just like hearing the story and seeing the demo?
I like both. I like decks a lot beforehand, just so I can skim through them for a little bit. Because usually, just thinking about the deck and the idea, and maybe doing a little bit of research for 15 minutes will give me like a few questions that I want to make sure I can hit during the meeting. But I think decks often don't capture the story quite that well, right? Like compared to the founder. And so it is always good to hear like the founder describe it.
Yeah, I'm conflicted on it because when I'm pitching investors, I kind of like using a deck, but when I'm listening to a pitch, I really dislike sitting through. I just want I just want to have a conversation about it.
I mean, I think part of it too is like it's where your strengths are, right? Because I think some people are really good, like just basically ad-libbing the whole pitch, and in those cases, like that can be really powerful. If you're not that good at it, I think using the structure of a deck can really help.
So pitch meetings done. Do you think it's good for entrepreneurs to follow up and multiple times, or do you think it's better for them to kind of play it cool and see wait for the response?
Um, I mean, I think follow-up is definitely worthwhile. There's like investors are pretty mixed on this. So unfortunately, some were sort of become non-responsive. Some are very responsive, and a lot are sort of like responsive, but kind of depending on how busy they are that week. Maybe it takes a day, maybe it takes like 5 days. Um, and so I think if you haven't heard from somebody for a few days, I think it's good to check in. And I'd probably like maybe check in one more time if it's been a few more days, and then at some point, uh, you know, write that off, right? As like like not spending more effort there.
Yeah. What is the psychology of investors that ghost entrepreneurs? I actually don't understand it personally. Like, yeah, it's happened to me a few times, like especially in the past, and I just don't get why they don't like respond and just say no. Like, why do people do that? I know you
So
would.
um, I mean, we try to like, I think maybe like 1 or 2% of the time, I get really busy and drop the ball and feel really bad about it. But we try to send feedback when we can, because I think like if somebody invests a few hours of their time with us and then gets a no, like it feels unfair if we're just like no and then like that's it. So I think we try to kind of pay back that time with some feedback in case it's helpful.
Yeah.
When I got into venture, the things I heard were basically like, one, like if you give somebody reasons for why you're not investing, they'll push back and sort of, maybe like it ends up being like a big time sink for everybody. Um,
Does that
the
not happen with you when you give them a reason?
It's
Like,
pretty rare.
oh,
I think, I don't know if it's because of how like how I operate on these, or if it's just like this is how things work. But usually I'll send a founder like 3 or 4 things I thought were pretty interesting or exciting, maybe 3 or 4 areas of questions, um, or like hesitations. And so I get pushback on that maybe like 1 or 2% of the time. It's pretty rare. I have a feeling if I sent like one thing as like a pushback or like as a hesitation, then I'd probably get a lot more pushback because then people would be like, "Oh, you misunderstood the one thing you really like that made you pass. So like, let me explain it to you."
yeah.
But I think when you send 2 or 3 or 4, it's harder to argue against like 3 or 4 things at the same time. Um, so back to your original question, I think sometimes the investors are afraid of getting pushback and like kind of spending a lot of time, even though they decided to pass. I think the other concern I've heard is that if you pass on a founder, they'll sort of like they'll resent you like when they if they raise in another year or two, like they won't come talk to you. I guess it's hard to measure that. In my experience, that's also not been true. But it's hard to know, right? Because like if somebody raised without approaching me, it's hard to know the reason.
Yeah. I mean, I'm much less likely to go to an investor that like just ignored me afterwards
Yeah,
versus someone who just gave me like yeah, just a no is fine, but an
yeah,
explanation is even better, right? Especially if it's a thoughtful explanation.
yeah,
Uh,
absolutely.
okay, so how do you think about valuations? I think someone asked these questions, but like, should you be pitching specific valuations? Like, how should you value your company? Is there some like rough kind of ballparks when you think about this?
Sorry, from the founder side or from the
Yeah,
investor side?
from a founder's perspective. I guess both would be interesting.
I mean, I think so. From the investor's perspective, we have that one's quicker to answer. We have a bunch of sort of comps from just like what we see in the market day to day. So I think a lot of times we have a rough sense of okay, based on the traction in the team, like a fair valuation here feels like $8 million post or 12 million or 15 million or whatever it is. So for us, it's kind of pattern matching. But then where it gets complicated is when if somebody does get a lot of term sheets, then sort of the patterns go out the window and it becomes more of a like there's a lot of people competing. How much am I willing to pay to like kind of stay in the competition? Um, on the founder side, I think the most important thing is to figure out how much capital you need, right? So you have a plan for your business for the next 18 or 24 months, and you have some spending plan. Maybe you have some conservative revenue assumptions. And so whatever amount of money that is, like I would try to raise that, maybe plus a little bit of cushion, like 20% cushion or something. And so if you have a number in mind, like let's say you need to raise 2.5 million, I wouldn't give a valuation out when you're trying to fundraise, because I think what happens is if you guess too high, you'll turn off a lot of people that are like, oh, I would have invested, at a $10 million valuation, but since you want 15, like that's, I'm not even going to engage. But you also get the opposite, which is if you guess too low, maybe some VC was like, oh, the market price was 10 million, but you asked for 7. So like, okay, I'll give you 7. And so I think just, stating a fundraising amount and then letting the market set the terms, which you can always negotiate with if you don't like them. I think that's the best strategy.
Yeah. I mean, the other problem with going too low is then it feels like there's something wrong with the deal. It's like, wow, this feels like a 10 mil deal, but with 5
Yeah.
mil, there's something wrong here. So I guess, one thing that I think entrepreneurs struggle with is this question of, oh, how much do you need? And it's not, especially if they haven't raised anything up to that point. They're like, fuck it, I'll do it with 0 if I have to. Or they'll be like, okay, if I have 3, I can do this much with it. So how do you answer that question? Like when, especially with a software company, there isn't necessarily a capital requirement. It's what does it take to, there's like, so you can operate under a lot of like different funding kind of
Yeah.
models.
Yeah. It's a tough question. I mean, I think a useful exercise is to maybe work back from where you think you'd have to be for the next fundraising round. And I say that because I think a lot of like founders often feel like, hopefully if I raise this, 1 million, 3 million, whatever, like hopefully I'll never have to raise again. In reality, I think most either have to or choose to. And so if you think about like, let's say you're raising a seed round, you want to think about Series A milestones and like what the Series A investors might want to see. And they're pretty public about this stuff, but you can also, sometimes you can talk to them one-on-one, maybe like if you know somebody directly, or you can meet them through an angel investor. So if you talk to a few Series A investors, maybe they'll tell you like, hey, for your business, I really want to see you have like, 100 plus SMBs as customers, or, I want like 10,000 daily actives on your consumer app. And so then I think you're trying to figure out, okay, if, I talked to 3 or 4 investors, or I read some blog posts, like I have a sense of what I'm aiming for. Like how much capital would it take for me to, like have a good shot of getting there in, some timeline, like 18 or 24 months. And so I think that often determines the fundraise amount, right? Which is like, maybe you can get by in 400K, but you're not going to get to like, Series A milestones with 400K. And so, like in that case, you start asking like, well, maybe 400K is not the right amount. And so you kind of go through that exercise of like working backwards from where you want to be in a year and a half or 2.
If there's a company you like and it's being bid up in terms of valuation, do you start thinking a little bit like, oh, if it's going to be $1 billion company, and then it doesn't matter if it's 15 or 20, or do you think that's like a bad road to go down?
This is a tough question because I think on an individual company level, if you think this is going to be, like a $10 billion company, then the seed round sort of makes sense at almost any price. I think at a portfolio level, it's really hard because, if you paid like 50% more for every single company, then your returns get cut by a third in the end, right? And so I think that's the tension, right? Like if you, if a typical fund might invest in, 25, 35, 40 companies over a few years, if you have like 1 or 2 in that cohort where you're like, this company is like, I invest in a lot of great companies, but this one's like really, really special. It makes sense to pay up there if you have to. But you can't do that every single time because I think it hurts returns, for your own LPs.
Yeah.
And
What is
we've definitely been burned by that in the past too, right? Because I think on average it makes sense to not overpay, but there's times where, we'll like some company a lot, but they did raise their seed round at, a high valuation. And like we just couldn't get comfortable with it, but then they ended up doing really well.
Yeah. So you specifically don't do pre-seed, right? At least that was the impression.
We'll do it a little bit, but it's pretty rare for us. It's maybe like 5% of our investments. We're mostly like kind of the core, like $2 to $5 million seed rounds is where we play.
And is that because your fund size is so big that like investing less money doesn't make sense? Is that the reasoning?
I think it's a couple of things. I think part of it is like we want to be helpful and involved, and so just in terms of like deploying the capital, I think we're okay with investing earlier, but it's more like if for $1 million I can invest in like 3 pre-seed companies or 1 seed company, uh, that $1 million is like kind of the same, but like the pre-seed companies would take 3 times more time. So we'll sort of do it when we maybe like know the founder really well, or maybe we know their space really well, and we feel like even like really early on we could be helpful, and like, you know, it would be like great for everybody involved. Um, but in general, I think where we're most effective is when somebody has like a tiny bit of early traction, or maybe it's like a B2B company and they have the first couple of pilots or the first paid customer or two. And I think where our strength is like helping companies get from there to like true product market fit, like to Series A traction, to like kind of, you know, starting to scale like a great company. So I think, you know, naturally, like those companies with a little bit of traction, they tend to be more seed stage than pre-seed.
What percentage of your companies that you invest in reach Series A?
Um, we kind of calculate this maybe like once every year or so, coincidentally, right next to our LP meeting date. And historically, it's been kind of in the like 70-ish% range.
Wow, 70% hit Series A. That's great.
Yeah, we've been pretty happy with that. I've seen a ton of industry benchmarks on what the average is, and I've seen everything from like, you know, 20% to like 50%. But I think the average is somewhere around like 30% of seed companies hit a Series A. So we're really happy that for us it's about double.
What is a interesting like return for you where you're like, okay, you know, obviously if a founder gets to like a $10 billion company, you're like, this is amazing. But like,
Yeah.
where's the number where you're like, okay, you know, this is now interesting. It can really like help the fund.
Yeah, I think we think about it as like if something can return roughly like half the fund or more, that would be really interesting. And so to make it more concrete, we have a $90 million fund. We'll write, you know, checks that are maybe like 1.25 million on average. And so you're kind of thinking like, okay, if I invest 1.25 million and I want to see, you know, at least a $45 million return in like a best case scenario, I think that's roughly like a 40x or something like that.
Yeah.
You know, ignoring dilution. And so maybe this is where the valuations are like matter, right? Because if you're investing in an $8 million post, and you know you can afford to like kind of you know, keep dilution at bay for a few rounds, maybe like a $300 or $400 million exit is meaningful, but like really meaningful to the fund. But if we're investing at like a $20 million post, and we probably can't afford to pay pro rata and like avoid dilution for long, then maybe you need something more like $1.5 billion exit for like that same level of meaningfulness. And so that's where like that early valuation is really important to us.
Yeah. I think this is a place like it's actually like probably the primary form of misalignment between investors and entrepreneurs because
Mhm.
like to the entrepreneur, even a 30 million exit would be like life changing, right? Whereas to
Yeah.
the fund, it's not meaningful. Have
And
you, I mean, and also on Twitter, like people get really worked up about this. That yeah, if an investor says we need $1 billion exit, like people are like, oh, you're crazy. Like, yeah. And I think that is because of this misalignment. Have you found ways to like, you know, help solve that misalignment if there is a way?
I guess at least for us, I would say like I don't feel like there's a super strong misalignment. I think we're pretty aligned with founders. I guess the way I see it is, you know, like exits are sort of like this, like, you know, probability distribution, right? Where, you know, a couple percent are huge, and then maybe like 15% are like, you know, big, and like, you know, 40% are okay, and like, you know, 40% are not that great. Um, and and I think it's really hard to tell both for the investors and the founders, like where a company will fall in that distribution. So everyone's hoping for that, you know, top couple percent, but like, you know, it's like a roulette wheel, right? Like you can't just like predict which number it's going to land on.
Mhm.
And so I think for me, in terms of, you know, like if a founder has a $20 million exit, you know, or like even a $5 million exit, um, like I don't feel like, you know, misaligned on that, because I just feel like, okay, like, you know, there's this distribution and they landed here. um I think for me, like the part where I feel misalignment is if it feels like a company is doing great but like the founder wants to sell early, because then it feels more like unrealized potential versus like, well, you know, like they did their best and the company exited for, you know, 14 million, and that's what, you know, that was great. If instead it was like, you know, maybe they sold for 200 million, and we'd still be bummed because, you know, like it was because the founder like just like maybe like wanted to stop, versus, you know, the company has a trajectory to be worth like 600 million in a few years, and it was like a really clear line of sight. So I think for us it's more about like if you put in your best effort, we're happy with the outcome no matter what. And then if you give up, or if you know, like sell when it seems like the company's doing amazing, I think that's when it gets a little bit more frustrating.
Yeah. Let me try to pick off a few of these questions. Yeah, how do you think about kind of this remote teams now? Like, do you care about where the founders live, where the rest of the team they live, or is it just doesn't matter anymore? You're like all in on remote first.
Um, I think we care less and less over time, and I think that's probably true for most investors as well. Uh, there's occasionally times where it matters, right? So, like for example, like if you're building a product that needs, Google level machine learning engineers from, like Google Brain or something, like you probably have to have a good presence in the Bay Area. Like maybe you can recruit them if you're like in the middle of America or like in another country, but it's a lot harder. Um, but for most projects, I think a lot of the team can be distributed. Sometimes the sales team has to be concentrated in a certain area if you're selling to like a certain type of, like for example, if you're selling to media, maybe you have to be like in New York and LA or something.
Mhm.
But mostly like remote feels fine. Um, the one caveat I would say is I think we're more helpful like in certain areas, right? So if a founder's in at least the US and maybe in the Bay Area or New York or some of the big tech hubs, that's where like if they want an intro to like a potential VP of sales candidate or like a mentor or an advisor, we have a much stronger network there versus like if they're in, maybe if they're in like Hungary and they want like local help, like that's probably not something we'll be able to help with. So that's something we think about a little bit because our goal is to like invest, but also help out if we can.
Yeah, but you only invest in companies that are incorporated in the US, right?
Yeah. Well, we've invested a lot in the U.S. and Canada, a little bit in Mexico, and then I would say like we're open to internationally. For us, those end up being less about where the team is based and more about if they're targeting a market that we just don't understand well, right? Like if there's selling software to like companies in Germany, but like we don't really know how companies in Germany operate, then like that's usually the friction point for us versus where the team is based.
Do you avoid investing in things that conflict with one of your existing portfolio companies? Do you have like no conflict kind of rule?
Yeah, we usually we try to check it with each side if we think there might be a conflict, and it's hard to like and avoid forever outright, right? Because people will pivot, right, or like they'll expand their products. But I think our philosophy has been that if you're unlikely to compete for at least a few years, that seems good, and if you're likely to compete in the next couple of years, that feels a little bit too uncomfortable, right? Because like we don't want to be in this position where if we help one company, it hurts the other, or like maybe we can't help either because like it would be favoritism. So we try to avoid conflicts at all costs.
Oh, you do. Okay. What happens if it's like one is like a Series D or E company that you invested in like 5 years ago and you're not heavily involved in it? Would you change your opinion there, or even then you wouldn't do it?
So we're actually just starting to hit this because like a few of our early investments like Robinhood and Flexport are like really far along now. I have a feeling they wouldn't care if we backed like a seed stage, Flexport in some other country or like Robinhood in some other country.
Mhm.
Um, and also because I think like at their levels where they have like a couple thousand employees, like we're not day to day involved at this point, or even like month to month involved really. But I think if it's like a seed Series A, Series B company, we're definitely we're gonna ask them if it's a problem, and if it is, like we're not gonna engage with other companies and like create conflicts.
Yeah. How important do you think is kind of the vision and roadmap when in seed stage? Like, how much is it like, this is what we've achieved and this is what we'll do for like the next year or two versus like, this is our 10, 20-year kind of plan?
I think both are actually really important because I think if you over focus on one, then like people wonder about the other, right? So like if you have a really amazing 10-year vision, but you don't have like a great plan to get there, just like or make progress in the next year or two, I think it's hard to invest. I think on the flip side, a lot of times like the 10-year vision is awesome, but like the next 1 or 2 years are, like you're going from like a non-existent company to a tiny company, right? And so like painting this pitch of like, hey, we're going to be a tiny company in a year and a half is not as exciting as saying, hey, like here's our vision, and then here's the first couple steps to get there, and kind of drawing that like drawing that line in the investor's mind of like, hey, this is the trajectory where like in a couple of years this will be tiny, but then a couple more years it'll be mid-sized, and then in 10 years it's going to be giant. So I think you want to hit both.
Do you think it comes across sometimes as disingenuous when someone's like, you know, like 100 million people in America will use this and pay us $5 each and we'll make five, that kind of thing?
I,
Uh,
a little bit sometimes. I think it depends on like some problems are universal, right? And so if somebody says like, okay, uh, like Robinhood's a pretty good one, right? So they have like no $0 commissions, and I think nobody loved paying high commissions, right? And so whatever the size of the brokerage industry was, and however many people had brokerage accounts, I think you could say like, okay, like all of those people will want like Robinhood someday, or maybe the majority of them. I think maybe other products are really valuable, but maybe more for a specific audience. So like let's say Superhuman, right? I think that's a client for the 1% like email power users, or maybe 15%, but probably not 100%. And so I think if you go out pitching Superhuman as like, hey, there's 400 million Gmail accounts, we're gonna have 400 million Superhuman accounts. I think that comes across as like disingenuous or delusional. But I
Yeah.
think if you're like, hey, we're gonna have 10 million, but they're each gonna pay us like $400 a year, and that's a big market, like that sounds like a great pitch.
How do you think about kind of more creative kind of mediums of pitching? I guess like the less creative one would be just a PDF versus like someone doing like pre-recorded like 2-minute video or something like that to sell the idea. Like, do you prefer just like simple, or are you interested in like someone being a little creative with how they pitch it?
I would say I'm probably neutral on it. I like creativity, but I think there's also like a practicality element. So for example, like a pre-recorded pitch, I think if it's 2 minutes, that's great. I think if it's like 15 minutes, it's it takes a much bigger amount of time for me both to like look at it myself if it comes, let's say, through like a cold email, but then also let's say you send me a 15-minute video, I watch it, we have a meeting. Then when I talk to my partners and I'm trying to tell them why I'm excited about Mercury, I'm like, hey, you guys should all watch this 15-minute video. And I think that starts being like a pretty big time burden on, as you're like sharing this with other people. And so I think if it's short and like easily consumable, it's great. If it's, a 40-page memo or like a 15-minute or 30-minute video, I think you want some shorter piece of collateral alongside of that you can send that's like more of a summary.
Yeah. Is there, do you sometimes come across like pitches where you're really into the market and maybe the product's good or the traction's good, but you think the founder's like lacking something, like maybe they don't sell it very well, or the other way around? Like, how do you, is it like all of these attributes kind of like, if there's one red flag, then it's like you wouldn't do it, or would you be willing to take one red flag if the other attributes are great?
I would say we'll take yellow flags. I think red flags are hard. I would say actually like some of the hardest decisions we've had are like where we like really, really love the founders and then like really hate the idea. And it doesn't happen often, but maybe a couple times a year it'll happen where like, this is like such a wonderful founding team. And like, this seems like a dead end business. And obviously like we're often wrong, but it's just like, it's like sometimes we feel really strongly about like positively on the team and negatively on the product or the market. And so those are really hard for us because like we want to work with the team, but like we usually have a hard time justifying it. On the flip side, I think when like the product is great or the market's great, I think it depends on how we feel the team is not great, right? If it's like, maybe they don't have experience in an industry or they don't have a lot of leadership experience, that's more of like a yellow flag, but we can definitely overcome that. I think if it's something more like, well, we don't trust them, or like they have a bad reputation or things like that, those are things where like even if we love a product, I think it's hard for us to justify moving forward.
Do you think about the ethics of an investment? Like, you're like, okay, I think this will make money, but we're not sure. Like, we believe in like the positive things that this would have on the world, or you don't really focus on the ethical side of a company.
We try to, I think, both for personal and financial reasons. I think on the personal side, I think all of us want to be involved in like things that make the world better instead of maybe they make it worse but make money doing it. So we think about that a lot. I think we try to only invest in things that are like kind of like net positive versus negative. Um, and then I think on the financial side, what we've actually seen is the companies we've worked with that have really good social missions or like really good missions alongside of the business. So like there's like Andela, which trains engineers in Africa and helps them find jobs around the world, or like LendUp, which provides like better short-term loans to like underbanked people. Those companies have a much easier time with like fundraising, recruiting, like getting PR. Because I think when you have a good mission, everyone's excited about it. So I actually think if you have a really good mission, it's not just something that like you and the investors are excited about. It's also something that like probably increases your chances of having a great exit.
Yeah. Someone is asking, you said when you love the founders, like what are attributes that you often like love about a founder? Is it kind of their past experience or the way they talk about it, things, or a bit of everything?
It's a bit of everything. I would say, some highlights are, I think like founder market fit is good. We do a lot of B2B investing. And so sometimes you meet somebody where, they're like, I'm building this product for, like corporate legal departments, but I spent like my last 20 years working at 4 companies, that like all service this customer, or where I was a customer, where like they just have such a depth of knowledge where it's really exciting. So I think founder market fit's one. I think, for lack of a better word, like kind of founder charisma or ability to sell is another one. Again, because we're thinking about, like, will the person be able to recruit well? Will they be able to fundraise well in the future? So I think that's an important signal. I think high grit is another one. Startups are like really hard. Even as an employee, like as an engineer, I had a few times where like I'd sleep under my desk to like finish some project, but I think that was like a very temporary time. I think for founders, there's this like, you're kind of like the buck stops with you. And so I think there's a lot of stress there. And so people that have, high grit, like they're willing to work through tough times, I think that's really important. And then maybe the last one I would mention is I like people that are like really thoughtful and, have like gone through the idea maze in their heads. If in the case people don't know that word, it's sort of like, when you have an idea, like, you're here, success is here, and there's all these different paths you can take, and some of them work and some don't. And so there's this kind of maze, and you're trying to navigate from your start point to success. And I think the best founders have this like really clear vision of like, okay, I'm going to take this route. And then if the investor's like, well, why don't you go here? The founder's like, no, this won't work for this reason. And sort of like any question I ask, the founder's like, no, I've gone down that track. Like, this is the right path. I think that sort of like thoughtfulness and confidence is like really, really inspiring to me personally.
Yeah. I think one of the issues with the idea maze thing is like the first kind of 1 week of pitching you do your answers to those ideas maze questions. But like the next week you're like, oh yes, I've come across this question before. Here's the exact answer to it. Which
Yeah,
is, but I think that's
I
reasonable.
think it probably is a little bit of that.
Uh, there's a little bit of a revival in like kind of consumer social mobile things right now with the pandemic. Have you done any of those? Are you looking at those? And how do you think about that revival?
I would say, we've skewed much more towards B2B in the past, and then like much more being something like 70%. And then for that other 30%, it's tended to be things that, monetize like customers directly, instead of with ads, or, kind of with like kind of ads at scale. So that'll be like Robinhood or like e-commerce companies, things like that. We've done a tiny bit of consumer social, but not that much. So I don't think I have enough experience to really like say much there.
I get a little more abstractly, some of those ideas sometimes like don't make money for a while, right? I mean, that's sometimes true in
Yeah.
B2B as well, but rarely. Is that tricky to invest in if it's not making money initially? And like, what are the things that you look for in terms of traction if it's not making money?
Well, so I think this is actually why we focus more on the companies that make money directly. I think one of the things we found is, we talked earlier about this like seed to A graduation rate being, something like 30%. And I think what we found is when we invest in B2B companies, sometimes they raise a seed round, they make some progress. It's not enough for a Series A, but if they have some revenue, like maybe they have like 40, 50K a month, and, Series A investors want 150, but like 40, 50 is still something. The companies can use that money to like bootstrap for a little while, maybe to grow more organically, either get to a better exit, or, get to a stage where they can raise a Series A. And so I think having revenue early on gets you a lot of optionality. And I think when you don't have that, it's much more binary, right? Which is like, our goal is to get this level of traction, like unpaid. And if we do it, we can raise a Series A. And if we don't, then like we can't. And I think that's a trickier spot to be in. But I mean, I would say anecdotally, like the things that matter more for like the unpaid side are, is retention good? A lot of times it's sort of like, there's a lot of your growth organic or referral based, right? Because when you're not pulling in revenue, paying for customers actually is like really tricky, because like you probably don't have a lot of money to pay with.
Yeah.
And then I think also just like, are there a lot of users that are like just really passionate, or like evangelists? Or I think if people have been following Rome on Twitter recently, like, is there like a cult of really excited, happy users?
Do you think it's tricky for people sometimes to kind of get to the seed stage if they if they're younger, they don't necessarily have the money to support themselves for some time period. Is there like a kind of like systemic bias a little bit towards people who have a little bit more money and a little bit more credibility in the seed market?
I think there's definitely a bias towards credibility. And I think there was more of a bias on the money side, but probably a little bit less now. Because I think you have things like, now there's pre-seeds, right? Where you don't necessarily have to qualify, like you don't have to be, have enough progress on your own bootstrapping, like in your own budget to get to like, a $10 million valuation. Maybe you could start with like raising a few hundred K at like a $4 million valuation. And so I think that's, it's a lower bar to hit in terms of how long you have to bootstrap. And then even going down from there, you have something like Y Combinator, where I think they give you what is like 125, 150K. And they'll do that with, I think like no traction, like, maybe just an idea and some founders. And so I think the options there and like the sliding scale there has gotten a lot better, where it's not just like, hey, you have to have enough pedigree that somebody will trust you with like a $10 million Series A on day one. And now there's all these like smaller players that will give you, a million or 500K or 100K. And so I think that eases the burden a little.
Do you have a bias kind of against solo founders, or it's not a factor for you whether it's like, how many people in the founding team?
I would say we don't have a bias against solo founders specifically, right? So like, there's not like a, it's not a yellow red flag if somebody's a solo founder. I think what we're thinking more about is, what would the right founding team have for this company in terms of like skills, knowledge, experience. And sometimes, if the solo founder has all of those things, and that's great. On the flip side, sometimes you have like three people, three founders, and we're looking at a company where like, okay, they need like strong engineering and strong sales. And if the three founders are all engineering, then like, even though there's three instead of one, we'll still be wondering like, well, like maybe there's a big gap here. And like, are we comfortable with that gap? Like, can we help the company fill that gap? But it's more about that, like, what are the required skills versus like how many founders are there?
So once you've invested in something, like what is the best way for a founder to utilize you as an investor? Like what are things that work really well and like deliver the best value?
Yeah, I think there's a few dimensions to this. So for us specifically, and I think this varies a lot fund to fund, we like doing regular catch-up calls. So it might be, 30, 45 minutes, depending on the founder's preference, maybe as often as every couple of weeks, or as rare as maybe like once a month. And so the idea is like, let's say we're doing like a monthly, 45-minute call. The goal is like for 5-10 minutes, we'll talk about how the business is going. And then either if we can proactively see areas where we can help, or if the founder has questions or challenges they're facing, that, like we'll basically dig into those, see if we can help either right there, or like, like share some resources afterwards, make introductions to people, or maybe it's like, hey, you have a question, Immad, I don't have the answer, but like this other founder I work with solved the same problem 2 months ago. Like I'll introduce you guys. So that's like the cornerstone. There's like regular catch-ups. And then in parallel, like we're accessible by, phone and text and all of that. We've also been doing a lot of boot camps for founders around like pricing 101, PR 101, things like that. Kind of going back to the comment about, like each company has like a set of skills they need to succeed. A lot of times, like the high level ones like sales and engineering are taken care of by the founding team. But then like when you look at like PR, marketing, like, pricing, accounting, like a lot of times there's gaps there. And so I think we try to help people like fill those gaps a little bit in the early days.
How do you think about founders taking money off the table? I mean, it never happens at seed stage, but at later stages, like what's a stage where it does happen, where it's sensible, in your opinion?
Yeah, I've seen it as early as Series A. I think, small amounts in Series A's feel okay. Or like we've had a few founders, for example, where they had a family, they wanted to buy a house. San Francisco is really expensive, and they wanted to take, like 400K off the table in like a Series A. That seems pretty reasonable, right? Like, I think the goal for us is we want the founder to be like, happy with how their life is and not worried about, the day to day of like bills or, where are they going to live next month. But also like incentivized to like build a great company. And so I think there is this tension of like, you don't want to be too strict where you're like, hey, you can't take money off the table until IPO, because then I think it's a strong incentive for people to sell early if they're like financially strapped. But you also don't want to go in the other direction, which is like, hey, you can take, $15 million off the table in like a really highly priced Series A, um, and now you maybe don't care as much about the company because you're set for life. But what I've seen is usually like a few hundred K in Series A is rare, but happens. Usually if somebody has like, they're buying a house or they maybe have some like health bills or something. And then at Series B, it's a lot more common to like maybe see somebody take like 1 or 2 million off the table, and then it can grow over time.
Yeah.
And again, the goal is just like, it's mostly to align incentives. What I've seen is like the founders that need, that want to take like a couple $1 million off the table, um, they'll a lot of times they're actually reluctant to do it because like they're so bullish in their company that they know that if they sell 1 million today, it might be worth like 30 million in like 5 years. And so people usually they don't take that choice lightly, but when they want to take it, like we're supportive.
Um, Someone asked, should founders pay themselves salary at seed stage?
Yeah, 100%. I think the big question is how much, right? And so um, what I've seen is a lot of times found. Sorry, what?
Is there a certain level that's like the normal?
I think something around 100K is pretty common, but I've seen people go, low, like 30, 40K, especially if you're maybe like single founder or like not solo founder, but like you're unmarried, you're out of college, you're like used to living in a dorm. A lot of times people will take like a 20, 30, 40K salary because they're just working all the time. They're not looking for a lot of, they don't have a lot of bills and things like that. For people with like large families, I've seen things go up to like maybe like the 150, 170 range. That's probably a little bit less common, but it's definitely not unheard of. I think the biggest thing is like at Series A and later, you can definitely get like a market salary, even like a good, like strong high market salary. At seed and especially pre-seed, like runway is so critical and you don't have that much money, right? And so like, let's say you raise a $2 million seed round, the difference between like, three founders taking like 125K and maybe like 70K a year each is, maybe that gives you like 5 extra months of runway or something. I'm not doing the math. I'm just kind of estimating. And that's really meaningful when you like haven't figured things out. You're looking for product market fit. The difference between like 18 and 23 months of runway could like make or break the company. And so what I've seen is like founders will sort of take a smaller amount that they're still comfortable with, but where like they're not saving a lot, but like they're covering all their expenses comfortably, but they don't go high, like way over that. But then at Series A and B, like it really equalizes to like a healthy salary.
Yeah, makes sense. Um, what do you think about kind of these new ideas and kind of spaces that have become interesting during the pandemic? Like, which of those do you think will be kind of long-term wins versus it's like short-term and when everyone's back to normal, we want to continue?
Yeah, this has been like a topic of debate, I think, with a lot of investors I talk to. I think the big question is exactly what you just said, which is, is it like a temporary shift or is it a long-term shift? Um, I think the way I think about it is for a lot of products, if there were already some trends ongoing, like let's say remote work or remote education, or buying groceries online instead of in person, I think the big question for me is like, was the barrier to more people adopting it that like people are just like reluctant to try it, and like maybe like Instacart was always an amazing product, but a lot of people are just like felt weird buying groceries online, and then now that they've tried it, they're going to stick to it. Or is the barrier something else, right? Where it was less about trying it and more like the experience just wasn't that great. And so, for things like ordering groceries online, e-commerce, I think those trends just accelerate. And I'm guessing they're not going to go back to like, how they were in 2019 when the COVID pandemic is like more under control. For things like, education at home, almost all the parents I talk to like can't wait to get their kids like out and back to school. Because it's like hard to work from home with kids with like no daycare. So I think that's a trend that, I think temporarily has like a really strong boost, but might go back closer towards normal. Because the problem there was not that parents didn't want to try education from home. It was that they liked, education remote or like education out of the home.
Yeah.
So I think that's a big filter for me of like, what was the barrier for people doing this in the first place?
Um, you mentioned earlier like the founder market fit. Do you think that can be bridged a little bit with an advisory board? What do you think about like the whole concept of advisory boards?
Yeah, absolutely. I think advisors are great. You know, assuming they're like, they have the experience you're looking for. But like in my mind, like the main role of founder market fit is you kind of take a lot of shortcuts and avoid mistakes that, maybe like a novice in the industry would make, right? So Like let's say you're selling something to lawyers. Like if you've never worked with a lawyer, you're probably like, maybe you pitch it the wrong way. Maybe you're like pitching the wrong person in the organization. If you have experience in the industry, like you're going to avoid those mistakes. And so if you have that experience, that's great. If you can get it through an advisor or sometimes an employee, like an early employee, that works well too. The goal is just to like, what can you do to like kind of de-risk building the company? Maybe the one caveat I'd say is sometimes the founder market fit is more on the network side, because there's some industries that are really hard to break into unless you already have a network there. Because like people don't trust you, for example, like let's say like, if you're selling software to power plants, like people don't trust you if you're just like, a new grad that's like, coming from Stanford building software. And so I think there, the founder market fit's probably more about the network actually than the industry experience. And that one's harder to bridge. Advisors help a little, but like not as much as a full-time employee or founder.
If you have an OpEx heavy startup, I guess, fintech startups, healthcare startups, like they're kind of hard to get off the ground without raising that initial kind of funding round. How do you think it's even more important? Like how good are the founders and all of that stuff? Or is there another way that you think people can kind of get to the seed round when they can't launch a product?
I think there's definitely a higher hurdle for like kind of founder having a demonstrated track record of execution for like really operationally intensive businesses. Just because, like you said, they're slower to get off the ground, they're more capital intensive, usually margins are a bit worse. And so I think that's where, like if you're looking at SaaS and, SaaS software has like 90% margins, even if someone like executes kind of sloppily and it's 80% margins, it's like not a big deal. If you have something where you're like, oh, I'm, buying office space and, it's like $1 million in office space. And then if I do a good job, the margins are 5%. And if I do a bad job, they're really negative. Then like execution ability and like operating excellence really matters. So I think, those rounds tend to be bigger up front. A lot of times those are like the $4, $5, $6 million like seeds from day one. And then the founders also tend to be more experienced, like whether it's experience in startups or just experience in general, but like they tend to have more operating experience that they can point to.
What are the most important, like, let's say 3 things that you think a founder should do after they raise a seed round, like for the next kind of 3 to 6 months? Like what are the best things they could do to kind of maximize their chance of success?
It's a good question. I mean, I think one big one is to have like a good roadmap and like financial plan in terms of, you have this money in the bank, and you have some set of milestones you want to hit for your next round, either for your next round or maybe to hit break even. And so you just want to like think about, how much time does the cash in the bank give you? How are you going to spend it? Because you can't hire like everyone you want to hire probably on your seed round. So there's a lot of like prioritization involved, and it's good to think about that upfront versus, kind of like weaning it as you go, and then maybe over time realizing you've like misspent some areas. I think the other thing that's really important for seed stage companies is a lot of times people like when they go from raising, let's say like a 500K pre-seed to a $3 million seed, they will, 5 or 6x their burn really quickly because they have 5 or 6x more money. I think it's really important to grow more slowly until you like on the team side, until you have product market fit. Because I think it's really easy to overhire, like maybe you hire a sales team prematurely before like your product's ready to sell. And then you end up burning a lot of time and capital with like people that, maybe they're great employees, but they're just like, it's not the right time to have them in your company. And you end up burning through a lot of your seed round and then not making a lot of progress. And then you kind of get stuck where you don't have a lot of money left. We also haven't made a lot of progress. So like nobody will give you a bridge round. So I think like the best advice there is to kind of spend frugally until you're pretty confident you have product market fit. Trying to think of what a good third one would be. I think a third one would be like start building good relationships with your new investors, right? Because they're going to be supporting you for maybe 1 or 2 years, maybe like 10 years. They're going to be, lining you like they're going to be trying to tee you up for like a great Series A with like follow-on investors. And I think one thing I've seen is like, if a founder raises money and then they kind of go quiet for like 4 or 5 months, it's hard to like build those like relationships afterwards. And it's the same on the investor side too. Like I think if the investor goes quiet for a few months, like the founder disengages from them as well.
Yeah. We'll make this the last question. What is the best way to kind of prospect potential investors? Like, I guess, how do you find them? And like, is it like a magic kind of subject line or email that like you think gets like the best attention?
I think doing a little bit of research, and personalizing like when you reach out is helpful. If even prospecting in terms of how you reach out versus like how you evaluate them as you're talking to them.
Yeah.
So I think doing a little bit of research, like I think you know, a good constraint might be like, hey, what can you do in like 15 minutes, right? And so that instead of sending like a mass email to 100 people, maybe you spend 15 minutes on like 15 people, and in like 3 or 4 hours you emailed like 15 people. And I think when it's personalized to that level, you probably get a much higher response rate. And so I think things you want to look at, like a lot of investors on Twitter, you could see what kind of stuff they talk about. Sometimes they'll express either an interest or disinterest in your industry. I think you want to look at their past investments, both in terms of like, hopefully there's companies you recognize, because I think that, maybe that indicates that like the investor like has a little bit of legitimacy, or like they kind of know how to pick good companies. They know they've gotten to learn from working with companies. And then you're also looking for like, are they likely to invest in your space, right? So if they invested a lot in your space before, that's great, as long as they're not investing in a competitor. If they're a generalist, we're investing in everything, that's also pretty good. If they're like, if they're in one space and you're in a totally different space, you're probably not going to have a match. So like you can spend your time on someone else.
All right, Leah, thanks for taking the time. Sorry we didn't get to everyone's questions, but Leo, you've been great. If someone wants to get in touch with you, what's the best way for them to kind of pitch their idea or ask more questions?
Yeah. So my email is leo@susaventures.com, SUSA Ventures. And then on Twitter, I'm Polovets. So it's my first initial last name.
Let's catch up soon, Leo.
Great. This is a lot of fun. Thanks for inviting me.
Bye.